What separates successful investors from those who continually struggle in the markets? It isn't finding the right hot stock. It isn't predicting where interest rates are going. And it certainly isn't chasing the next latest investment trend. The greatest long-term investors all understand one simple principle. Your first job as an investor is not about making money, it's about avoiding losing it. In this video, we're going to discuss why capital preservation is the foundation of long-term investing and why protecting your portfolio during difficult markets often has the greatest impact on wealth creation, achieving spectacular returns during good times. Hey, it's Frank Nagy. Welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. Many investors focus exclusively on returns. They ask questions like, what can earn me 20% this year? Which stock will double? And what's the next big opportunity? But professional investors and fund managers often ask a completely different question. They ask, how much can I lose if I'm wrong? The difference in thinking changes everything. Because every investment carries risk, no strategy wins all the time. Markets move unexpectedly, economic conditions change, volatility increases. The investors who survive over decades aren't necessarily those who earn the highest returns. They're the ones who consistently avoid catastrophic losses. Now here's something every investor should understand. If your portfolio loses 10%, you need at least 11% gain just to recover. A 20% loss requires 25% gain. Losing 33%, you'll need 50% return just to get back and even. But here's where it becomes even more challenging. A 50% loss requires 100% gain just to recover. When your portfolio is cut in half, you must double what's left simply to return to your starting point. That's why avoiding large drawdowns is so important. Every dollar you don't lose is a dollar that continues compounding. DataBridge Capital Management applies non-directional investment strategies to portfolios with a focus on risk management and market analysis. The firm's objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth. Now, Investor A earns 10% every year with a relatively small drawdown. Investor B occasionally earns 20% or more, but every few years experiences a 40% decline. Although Investor B may have stronger years, Investor A often finishes far ahead over the long term and suffers very little devastating losses. Consistency frequently beats unpredictability. Some people mistakenly believe capital preservation means avoiding risk altogether, and that's not true. Risk is unavoidable. The goal is to manage it intelligently. Professional investment managers understand this. They define risk before entering a position. They determine how much capital can be exposed. They diversify, they monitor volatility, they understand correlations between investments. And most importantly, they recognize that no single trade or investment should threaten the entire portfolio. Successful investing isn't about being right all the time. It's about making sure that when you're wrong, the damage is limited. Capital preservation also helps investors avoid emotional decisions. Large losses create fear. Fear causes panic selling. Panic selling often occurs near bottom market. Then they miss the opportunity to recover at the bottom. This emotional cycle repeats itself over and over again. By controlling downside risk, investors are better able to stay disciplined. Discipline often becomes one of the greatest competitive advantages that an investor can possess. Every investor's portfolio should begin with one question: what level of loss am I willing to accept? Only after answering that question should you think about expected return. Professional portfolio managers often include diversification across different asset classes and strategies, carefully managed portfolio position sizing, clearly defined exit strategies, volatility management, and regular portfolio review of the strategies designed to reduce exposure during periods of elevated uncertainty. These principles don't eliminate risk, but they can help reduce the likelihood of a severe drawdown that permanently impairs the capital. At the end of the day, investing isn't about winning every day. It's about staying in the game long enough for compounding to work. Markets will always experience corrections. Volatility will always return. Economic cycles will continue. The investors who succeed are often those who prioritize preservation before performance. Preserving wealth is often the first step towards building it. To learn more about Theta Bridge Capital Management and our investment strategies, risk management approach, and portfolio construction, click on the links below in the description box.